Welcome back to the deep dive. Today we are cracking open a file that, quite honestly, creates ripples across Wall Street every single time it hits the SEC database.
Oh, yeah, it definitely does.
We are looking at the 13F filing for the Baupost Group for the fourth quarter of 2025.
Right, which is the portfolio of Seth Klarman.
Exactly.
And for those of you who track the super investors,
Right.
Klarman is really in a league of his own. I mean, he is often the one you watch when you want to see where the smartest, most risk-averse, safety-first money is actually going.
He really is. I mean, he's the author of Margin of Safety, which is a book so rare and out of print that buying a copy costs about as much as a share of Berkshire Hathaway these days.
Yeah, good luck finding a cheap copy of that one.
Seriously. But here's the hook for today's deep dive. And honestly, it's the kind of thing that makes you just sit up and stare at your monitor. We're calling it the Battle of the Oracles.
I love that title. It's fitting because usually the super investors, you know, the Buffetts, the Klarmans, the Howard Marks of the world, they tend to move in a herd when it comes to quality.
They like the same durable moats.
Exactly. They all like the same setups. But in Q4 2025, we saw a massive, violent divergence.
Yeah, violent is a strong word for 13F filings, but in this specific case, it really fits the narrative.
It does. I mean, picture this. On one side, you have Warren Buffett, the Oracle of Omaha, sitting on just this mountain of cash and aggressively selling one specific tech giant.
Aggressively so.
Right. He is cutting it by 77%. He's practically running for the exit.
And usually when Buffett runs for the exit, your instinct is to follow him. You just assume he sees an iceberg ahead that the rest of us are missing.
Usually, yes. But then you look at Seth Klarman, the Oracle of Boston, a man who is arguably even more risk-averse than Buffett.
Much more risk-averse.
A man who has spent his entire career avoiding high-flying tech stocks. And what is he doing with that exact same company?
He is backing up the truck.
He is backing up the truck, filling it to the brim, and coming back for seconds. I mean, he bought 2.1 million shares in the fourth quarter.
So you have a true billionaire standoff here. Buffett says sell, Klarman says buy. And the company in the middle of this tug of war isn't some obscure distressed debt play or some penny stock. It's Amazon.
It is Amazon. And that leads us to the billion-dollar question that we really have to answer today.
Right.
What does Seth Klarman see in Amazon's balance sheet that Warren Buffett is missing? Or, you know, play devil's advocate, what risk is Buffett seeing that Klarman is just ignoring?
And the stakes are incredibly high here. We're looking at a Baupost portfolio that has jumped in value by about 11% to $5.28 billion. So right now, Klarman is winning.
He is winning. And the mission for this deep dive is to really decode this shift. It looks like he is orchestrating this massive pivot from physical infrastructure, things like cement and roads, to digital infrastructure.
Yeah.
We need to figure out what his definition of value actually looks like in this tech-heavy market of 2026.
But before we unlock the portfolio and get into the specific tickers, we do have to touch on the macro picture for just a second.
We have to.
Because understanding market valuation is critical right now, especially since the temperature is running so hot.
It is. Valuations across the board are very stretched. And for a value investor, context is everything. You can't judge a stock in a vacuum. You have to judge it against the temperature of the entire market.
Right. And to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. It is a really great tool to keep in your pocket to see where we stand historically before you make these big mental leaps about value.
Absolutely. Essential context. And as always, we need to get the housekeeping out of the way before we dive into the specific numbers.
Right, the disclaimers.
Full deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations.
And remember, all contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. And if you want to access more advanced contents, welcome to subscribe on Deep Values A. We will share our latest researches and the most advanced AI agent tools for our contrarian friends. Don't forget to like this video. Much appreciated.
It really helps us keep the lights on.
Okay, so let's get into the headlines. Looking at the overview of the Baupost Group 13F for the period ending December 31st, 2025, what is the very first thing that jumps out at you regarding the structure of this portfolio?
It's the concentration. Klarman is not a closet indexer. He isn't buying 500 stocks just to hedge his bets against being wrong.
No.
He's holding just 22 positions.
22? I mean, that is incredibly tight for a $5 billion fund. Most mutual funds of that size hold hundreds of positions.
They do. It gets even tighter at the top. His top 5 positions make up nearly 44% of the entire $5.28 billion pot.
Wow.
This tells us something very important about his psychology right now. When he has conviction, he bets big. He doesn't dilute his best ideas with his 20th best idea.
Okay, so let's talk about that biggest bet of the quarter, the big reveal we teased in the intro. What was the specific mechanic of the Amazon move?
It was Amazon, ticker AMZN. And the sheer scale of the buy is what is truly shocking here. Klarman bought 2.1 million shares. The total value of that stake is roughly $490 million.
Nearly $500 million in one quarter.
In one single quarter. It instantly became his second largest holding, making up 9.28% of the entire portfolio.
That's a huge allocation.
He didn't just dip a toe in to test the waters. He cannonballed straight into the deep end.
And this brings us right back to that divergence, because at the exact same time Klarman is buying 2.1 million shares, Warren Buffett and Berkshire Hathaway are doing the exact opposite.
Correct. In the same Q4 period, Berkshire Hathaway slashed its Amazon stake by 77%.
Yeah.
They went down to just 2.27 million shares.
Unbelievable.
So effectively, Klarman bought almost exactly the volume that Buffett sold. It's almost a direct transfer of ownership from Omaha to Boston.
That is fascinating. You have two absolute legends of value investing looking at the same asset, the same balance sheet, the same macro market conditions, and coming to completely opposite conclusions.
Yeah.
Let's unpack that. Why the divergence? Is Buffett seeing something fundamentally wrong with the company?
I don't think Buffett sees something wrong with the company operationally. I really don't. It comes down to how you define margin of safety in 2026.
Okay, explain that.
For Buffett, you have to remember, he has likely held Amazon for a while. He has seen significant gains on it. He might look at the recent price run-up and see his margin of safety eroding. He's very much a preserver of capital at this stage of his career.
Right.
So he's rotating out of a winner to preserve cash, or maybe to find better opportunities that fit his traditional mold.
So Buffett is taking chips off the table. He's looking at the board and saying, all right, this has been great, but the easy money has been made.
Exactly. But Klarman is rotating in. He isn't looking at where the price was. He's looking at where the value is going forward. And he clearly sees intriguing value in specific high-margin segments of Amazon.
But hold on a second. Amazon isn't typically called a value stock. It usually trades at a massive premium. It's a growth darling. What is the valuation logic here that makes a strict value investor like Klarman bite?
Well, let's look at the actual numbers. By late 2025, Amazon was trading at roughly 21 times forward earnings.
Okay, 21 times forward earnings. Let's contextualize that for a minute. In the world of big tech, where we often see multiples of 30, 40, or even 50 for the real high flyers, 21 actually sounds reasonably cheap.
That is the key. Klarman views 21x as a compelling valuation for what is essentially a dual industry leader. You have to remember, you aren't just buying an online store where you buy your socks and batteries anymore.
Right. It hasn't been just a store for a long time.
Exactly. You are buying the dominant e-commerce platform and the dominant cloud infrastructure provider.
You're talking about AWS, Amazon Web Services.
AWS is the engine here. Klarman seems to believe the market is still underestimating AWS as a foundational cash cow. And the moat is widening.
How so? Because competition in the cloud space is incredibly fierce. You have Microsoft Azure, you have Google Cloud. Everyone is fighting for that enterprise territory.
That's true, but the integration of generative AI and large language models, LLMs, into the AWS ecosystem is driving massive, sticky growth.
Sticky being the operative word.
Exactly. The sources indicate that cloud-related segments saw 48% growth. Klarman is looking at that and seeing digital infrastructure.
I really like that term, digital infrastructure. It implies it's as essential as a power grid or a water utility.
That is exactly the thesis. If you believe that AI is the next industrial revolution, then AWS is the railroad that carries the freight. You cannot run the AI revolution without the massive compute power and the data storage.
And AWS owns the track.
AWS owns the tracks. And getting that at 21x earnings, while the pure hype AI stocks are out there trading at 100x earnings, that is where a value investor like Klarman spots a serious asymmetry.
So Buffett sees a mature retail and tech company that's had a really good run, and Klarman sees a mispriced utility company disguised as a tech stock.
That's a brilliant way to put it. Klarman is betting that the market hasn't fully priced in the durability of that cloud revenue. He thinks the market still views Amazon primarily as a retailer with low margins, when in reality it's becoming a high-margin technology utility.
Now, this idea of infrastructure actually bridges us perfectly to the next section of the portfolio. Because while Klarman was buying this digital infrastructure, he was aggressively selling off the physical stuff.
Yes, this is what we're calling the great harvest of physical infrastructure. For a long time, one of Klarman's biggest winners was CRH PLC, ticker CRH.
Right, the building materials giant. Cement, aggregates, asphalt, the actual stuff you build the physical world with. This was a classic Klarman play for years.
Exactly. And for quarters, Klarman was riding the stock up. He championed their move to a U.S. listing. He loved their physical infrastructure moat. But in Q4, he cut the position by 68.3%.
Wow, nearly 70% just gone.
Yeah.
Is he losing faith in the company itself? Is he predicting some sort of macro construction crash?
Not necessarily. This is a very classic value realizer move. We have to understand the life cycle of a traditional value investment. You buy when the asset is cheap and ignored by the broader market.
Right.
You wait for the catalyst, which in this case was the U.S. listing and the subsequent infrastructure boom.
Yeah.
And when the re-rating happens, when the price finally goes up to match the intrinsic value, you sell.
The gap closed.
The gap closed.
Yeah.
The margin of safety isn't there anymore because the price is now fair. So he is taking the win. He's ringing the cash register.
So he's taking that capital from roads and cement, which are now fairly priced, and deploying it into what he sees as the new infrastructure.
Which brings us to another massive ad in the portfolio, Fiserv, ticker FISV.
Fiserv. This is the portfolio's central nervous system.
I love that description. Fiserv is one of those companies that essentially runs the world silently.
I feel like Fiserv is one of those companies everyone uses on a daily basis, but nobody actually knows their name.
You're probably right. If you've ever swiped a debit card, used an online banking portal, or paid a utility bill online, there's a very high chance Fiserv's technology handled the transaction on the back end. They provide the core processing systems for thousands of banks and credit unions.
So why did Klarman increase his stake here by, let me check my notes, 145.8%? That is a huge increase. He more than doubled his bet.
It's massive. And it was triggered by a very specific event. The stock dipped about 5% in late 2025 due to some weak forward guidance. The market got spooked. They saw a little short-term weakness, and they sold off.
And when the market gets spooked by short-term noise, Klarman gets interested. That's the core contrarian instinct.
Precisely. He pounced on that dip. But the fundamental reason he loves it comes back to the moat, specifically switching costs.
Let's dig into that moat concept for Fiserv. You mentioned switching costs. To the average person, that just sounds like it's a bit annoying to change providers, like changing your cell phone plan. But in the banking world, it's more than just annoying, isn't it?
Well, it's not just annoying. It's essentially open-heart surgery for a bank. Think about it this way. If you want to switch your personal email from Gmail to Outlook, it's a pain. You lose some contacts, you miss a few emails during the transition.
Sure, but I survive. My life goes on.
Right. But Fiserv provides the core banking system. This is the master ledger that tracks every single penny, every loan, every deposit, every compliance and anti-money laundering check for millions of customers. If a bank tries to switch away from Fiserv to a competitor, and they lose even 0.01% of the data...
The bank is completely insolvent, or they get immediately shut down by federal regulators.
Exactly. The CEO gets fired, the stock tanks, and the bank might actually collapse. So as a bank CEO, are you going to risk your entire career and the survival of your institution just to save a few percentage points on software fees by switching to a competitor?
Absolutely not. I'm staying put forever.
And that is the textbook definition of a high switching cost moat. It gives Fiserv immense pricing power. They can slowly raise prices year after year, and their customers just have to swallow it and pay. That creates this incredibly sticky, predictable revenue stream that a guy like Klarman absolutely loves.
It's basically the Hotel California of banking software. You can check out anytime you like, but you can never leave.
That is actually a perfect description.
Yeah.
And the underlying financials back it up entirely. Klarman is looking at an attractive cash flow yield of around 14% on this.
A 14% yield. In this current interest rate environment, that is incredibly hard to beat.
It is, and it fits the broader theme perfectly. He is swapping the physical moat of a cement quarry with CRH, which is hard to replicate because of geography and permits, for the digital moat of bank processing with Fiserv and cloud computing with Amazon.
Which are hard to replicate because of deep integration and massive data gravity.
Exactly.
It really is a profound pivot from the physical to the digital. But it's not just about buying new assets, it's about extreme discipline. We saw him trim some other big tech names too. Let's talk about Alphabet.
Yes, Alphabet, ticker GOU or GOGL. He trimmed this position by 41.5%.
And this follows a trim in Q3 as well, so he is consistently selling down his Google stake. Is the core thesis broken there? Is he worried about ChatGPT or some new search competition eating their lunch?
No, and this is an important distinction to make for listeners. Value investors don't just sell because a company becomes bad. They sell because the price gets high.
Right.
He isn't exiting because he thinks Google is a failing enterprise. He is exiting because the valuation has expanded significantly.
Yeah, that valuation discipline again.
The stock essentially doubled between May 2025 and year-end. The PE ratio hit 23x. Now, to a growth investor, 23x for a monopoly like Google sounds totally fine. They'd happily pay 30x. But to Klarman, the margin of safety has tightened too much.
It's fascinating that he views Amazon at 21x as a screaming buy. but Google at 23x is a sell. It's a very fine line to walk.
It is a fine line, but remember the context of the price action. Google had just doubled. He's sitting on massive realized profits. Amazon, on the other hand, had been lagging relative to its historical potential. It's all about the direction of the gap between price and value.
The gap dynamics.
Exactly. With Google, the gap closed. With Amazon, he thinks the gap just opened up. It's about relative opportunity cost for his capital.
That makes total sense. It's just disciplined profit-taking. Now, what about Dollar General, ticker DG?
He trimmed that by 22.7%. Now, it's still a very significant holding, about 5.19% of the portfolio. But again, it seems to be part of this broader recycling of capital. He's taking money out of places where he has won or where the thesis is fully stable and moving it to where the asymmetry is simply greater.
Asymmetry, that's a word we hear constantly and that brings us to the anchors. The stocks he isn't selling or is even adding to that form the absolute bedrock of the portfolio. And the number one anchor is a fast food empire, Restaurant Brands International, ticker QSR.
Burger King, Tim Hortons, Popeyes. This is his number one holding across the entire fund, making up over 10% of the portfolio.
Now, I want to push back on this number one holding for a second. You called it an anchor, but I'm looking at the debt levels for Restaurant Brands International here. A net debt to EBITDA ratio of over 6.0x.
It's high. There's no denying that.
Hi. I mean, if I ran my personal finances with 6x leverage, my financial advisor would have a heart attack on the spot. Usually, conservative value investors run away from heavy debt because debt is what kills you in a downturn. Why is Klarman, the ultimate safety-first guy, comfortable with a balance sheet that looks this heavy?
It's a great catch, and it really is the central paradox of this holding. To understand why he's comfortable with that 6x leverage, you have to separate the concept of the owner from the operator.
Okay, walk me through that.
Okay, so in a traditional business, let's say a manufacturing factory, debt is terrifying because you have high fixed costs. If your sales drop in a recession, you still have to pay the factory workers, you still have to pay the electricity bill, and you still have to service that massive debt. You can go bankrupt incredibly fast.
Right. Operating leverage works against you in a downturn.
But QSR is a franchisor. They generally don't own the physical restaurants. They don't pay for the deep fryers. They don't pay the hourly wage for the guy flipping the burgers. They just collect a royalty check, usually a fixed percentage of top-line sales from the franchisee.
So even if the individual franchisee in Ohio is struggling with their profitability because minimum wage went up, as long as they are still selling Whoppers, QSR corporate gets paid.
Precisely. It is a capital-light royalty stream. The Klarman, it acts much more like a high-yield bond than a traditional operating stock. Because that cash flow is so predictable and requires almost zero capital reinvestment from QSR corporate, they can safely support a much higher debt load.
I see.
Klarman looks at that 6.0x leverage and doesn't see risk. He sees a highly efficient capital structure.
So he's essentially betting on the historical durability of the Whopper and the Tim Hortons coffee.
He is, and specifically, he's betting on management's new 5-year growth plan running through 2028. He believes that franchise cash flow engine is going to grow significantly faster than the debt interest compounding. He loves the asset-light franchise model enough to completely forgive the debt load.
It's a cash flow machine. Okay, let's look at the number 4 holding, Elevance Health, ticker ELV.
Now, this is a much more traditional deep value play.
It was trimmed slightly by about 3.8%, but it's still 8.4% of the total portfolio. Why does he like Elevance so much?
The valuation is just rock bottom. It's trading at a PE of 13.8x.
13.8x. In a market where the S&P 500 is trading much, much higher, that is undeniably cheap. That feels like a no-growth terminal decline multiple.
It does imply the market expects the company to stagnate entirely. But it is incredibly cheap for a company with this kind of massive scale. They have 117 million members. They hold the Blue Cross Blue Shield licenses in many key states.
Which is huge.
It's a regulatory and scale moat that is almost impossible for a new entrant to breach. You can't just start a new health insurer tomorrow and compete with that.
And I've seen some numbers regarding the intrinsic value models here.
Yes, some DCF discounted cash flow models suggest the intrinsic value of the business is around $588 per share. If the stock is trading where it was in Q4, that implies it is roughly 70% undervalued.
70% upside. That is exactly the kind of margin of safety you dream about as a value guy.
That is exactly why it's a top 5 holding. Even with the constant regulatory headwinds in the healthcare sector, even with the political noise that always surrounds these stocks during election cycles, the price is just too chick to ignore. He's essentially buying $1 for 60 cents.
Okay, let's talk about one more anchor, Union Pacific, ticker UNP. He actually added to this position.
He did. He increased the position by 8.8%. It's now his number 5 overall holding.
Railroads. I feel like this is the ultimate old economy stock. We just spent all this time talking about him selling cement to buy cloud computing, but he's buying literal trains. Why is Klarman buying more rails in 2026?
Because you simply cannot replicate the asset. It is a natural duopoly. Union Pacific has a 30,000-mile rail network covering the western two-thirds of the United States. You physically cannot build another one.
Why not? I mean, theoretically, couldn't a massive tech company just buy the land and build a better one?
The land rights alone would be practically impossible to acquire today. Think about trying to use eminent domain to cut a new path from Los Angeles to Chicago. The environmental reviews and regulatory approvals would take 100 years, if they were approved at all.
So the barriers to entry are infinite.
You cannot build a new rail network in America. Full stop. So they have an absolute monopoly on moving heavy, bulk goods across half the country.
And monopoly means infinite pricing power.
Exactly. And it's a wonderful business financially because of that. They generate a 40.4% return on equity. That is stellar for such a capital-intensive business.
And it's currently trading at a fair price.
Around 21.7x PE. It's not dirt cheap like Elevance, but for a company that will almost certainly still exist and dominate in another 100 years, it's a very fair price for a wonderful company.
I noticed something interesting about their capital spending, too. They aren't just sitting on the tracks, collecting tolls and letting the system decay.
No, management is allocating capital very smartly. They are spending $1.2 billion on locomotive modernization.
Is that just routine maintenance, or is there a strategic angle?
It's strategic moat maintenance. By making their fleet more fuel efficient and reliable, they lower their operating costs relative to long-haul trucking. Every single dollar they shave off their operating cost widens the competitive moat against the trucking industry. Klarman loves seeing that capital reinvested to protect the castle.
It's incredibly impressive when you look at it holistically. He has the digital railroad covered with Amazon AWS and the physical railroad covered with Union Pacific.
He's covering all the logistical bases. He effectively owns a toll bridge for the movement of atoms with Union Pacific and a toll bridge for the movement of bits with Amazon.
Let's move to Section 5, the new and notable smaller moves. Because sometimes the small sub-2% moves tell you where his head is at for the future.
Definitely. One interesting new buy this quarter is Molina Healthcare, ticker MOH.
A $108.5 million position, that's about 2% of the portfolio.
Right. And this fits perfectly with the Elevance thesis. It's diversifying his healthcare exposure. Molina focuses much more on government-sponsored healthcare programs like Medicaid.
Oh, I see.
So he's betting on the managed care sector as a whole being fundamentally undervalued. It suggests he thinks the broader market is way too pessimistic about healthcare regulation right now.
And then there is Eagle Materials, ticker EXP. Now, this one actually confuses me a bit. We just spent 10 minutes talking about the great harvest of physical infrastructure and how he brilliantly sold CRH. But then he increased his stake in Eagle Materials by 26.1%. Eagle makes cement and wallboard. Why sell one cement company and aggressively buy another?
This is a classic example of why bottom-up stock picking matters more than top-down sector picking for a guy like Klarman. It shows he isn't just a macro investor playing trends.
How so?
If he were just making a broad macro call that the construction cycle is dead, he would sell both. He would dump the whole materials sector entirely. But he sold CRH and bought Eagle.
Right.
This tells us he sees something very specific in Eagle's valuation or their operations that is demonstrably superior to CRH at current market prices.
So it's highly specific stock picking.
Exactly. Maybe Eagle has better domestic exposure, or a cleaner balance sheet, or simply hasn't re-rated as fully as CRH did over the last year. It proves he isn't just painting the market with a broad brush. He's still out there looking at every single business individually. He's digging through the financial footnotes.
And finally, the exit. PagSeguro, ticker PAGS.
Fully liquidated. It was a very small position, less than 0.5%, but it's completely gone now.
Just cleaning up the tail end of the portfolio.
Likely. PagSeguro is a Brazilian payment processor. It seems he just decided to consolidate his payments bet entirely into Fiserv. I mean, why hold a smaller, much riskier emerging market player when you can just pile your capital into the dominant U.S. player like Fiserv when it goes on sale?
That makes total sense. Consolidation into your highest conviction ideas. Why bet on the unpredictable underdog in Brazil when you can own the undisputed king in America?
Precisely. It's risk reduction through concentration.
So we've looked at the massive buys, the strategic sells, and the unshakable holds. Try to synthesize all of this. What is the Klarman method actually looking like as we head further into 2026?
I think there is a very clear overarching pattern of capital cycling here. He is systematically moving capital from realized value to asymmetric opportunity.
Break that down a bit more for the listeners.
Sure. Realized value is CRH and Google. The original investment thesis played out exactly as he hoped. The price went up to meet the intrinsic value. The safety margin shrank. So he sells. He takes the profit off the table.
And he recycles it?
Into asymmetric opportunity. Things like Amazon, Fiserv, Elevance. These are great foundational businesses where, for various reasons, whether it's market skepticism, temporary weak guidance, or just vague regulatory fear, the current stock price is temporarily depressed relative to the long-term cash generation of the business.
He's constantly rotating the crop. He never falls in love with a stock ticker. He only loves the value it represents.
Yes. And there is a real tech nuance here that is absolutely vital to understand. He isn't suddenly buying into AI hype. You don't see him out there chasing the latest semiconductor startup that's trading at 100x sales.
Right, no NVIDIA, no pure play experimental AI chips.
Not a single one in this report. He is buying the established beneficiaries of AI that are already massive cash-generative platforms. AWS benefits hugely from the AI boom, but it was already a cash cow before ChatGPT even existed.
Yeah.
Fiserv benefits from the push toward digital banking, but it's already immensely profitable today. He wants the secular growth, but he absolutely refuses to pay the high premium for it.
It's essentially growth at a reasonable price, but protected by a deep value investor safety net.
Correct. And if we go back to the Buffett comparison one last time to tie it all together, Buffett is selling into strength across the board. He is raising an unprecedented amount of cash. That is a purely defensive macro move. It says, I don't see anything out there safe enough for my capital.
And Klarman?
Klarman is rotating rather than retreating. He is saying, I still see safety, but I have to look in completely different places than I did 3 years ago. To Klarman, Amazon at 21x earnings is the new safe harbor.
That is a profound shift in mindset. The idea that a massive tech giant is now a defensive, deep value play.
It really highlights that margin of safety is entirely subjective. It's not just a static formula in a textbook from the 1950s. It evolves as the underlying economy evolves. If the broader economy becomes intrinsically digital, the margin of safety must eventually be found in digital assets.
So let's wrap this up. We're looking at a $5.28 billion portfolio, a massive tectonic shift from physical cement to digital clouds, a direct bet against Warren Buffett on Amazon, and a huge double down on the hidden plumbing of the financial system.
It is a portfolio that is perfectly positioned for a digital world, but it remains completely grounded in old-school valuation discipline. He isn't fighting the future, but he isn't overpaying for it either.
And that leads us to our final provocative thought for you, the listener, to mull over this week.
If Seth Klarman is right, if Amazon is indeed the new ultimate value stock, what does that say about the rest of the market?
Right. If the supposedly cheap stock is trading at 21x earnings, where does that leave everything else in your portfolio?
Exactly. Are we entering a new era where digital utility is the only true safe harbor left? If the physical world is fully priced and the pure hype world is dangerously overpriced, is the only place left to hide the companies that own the digital railroads?
Definitely something to chew on.
It really is.
Just a reminder, if you want to track the market's temperature yourself and not just guess, check out the Buffett Indicator iOS app. It really helps to visualize these valuation gaps we've been talking about today. And for those who want to dive even deeper with advanced AI tools, deepvalues.ai is the place to go.
We'll have all the links and the full research reports in the description below.
Thanks for listening. We'll see you in the next deep dive.
See you then.